This is the first session of the Foundations of Finance. To me, finance is at the heart of almost everything that you know. Business as among the old saying about money sounds crass, but in a gas aspects of business, you are talking about strategy, marketing, human relations, public relations. It's still always about the money. That is how I think about finance when I teach my corporate finance class and when I teach my valuation class. In fact, I often ask what is the difference between the two classes. Are there actually a very simple way of describing what is the difference between corporate finance and valuation corporate finance? You look at a business from the inside out. You are looking at a financial decision making within a business. How do you run a business? Well, and how do you create a value business in valuations? You are looking at the same business from the outside. So, in the driving nations, it's always about the money. And what do you like to talk about in this session? Six building blocks that you need to know, matter what finance class you take now. This is my first subjective judgment. There are other building blocks, but these are the six buildings blocks are to make me of the finance. The first finance are very simple at the same very complex and way looking a business is. So I'm going to start off the concept and structure of a business at least as we finance, and in the process of we are going to lay out the physiological foundation finance, which is always forward looking into about what you have done as past, but what I drives the way we think about decisions making. The second big concept we are going to talk about the cash inflow finance. It's all about cash flows, and but it is opposed to what opposed to accounting learning. Some book value of assets, it always about cash flows. Understanding what drives cash flows, why they are different from earnings, so the different types of cash flows is the center understanding finance. The third is notions of the driving force of a risk. Everything in finance, it's better measuring risk and making sense. You are already written to that sufficient given risk taken. You have since in the process we have to got define risk is, and we have come up with the perspective, and this sounds strange, but I will talk that in a moment. The fourth big idea on which finance is based on the time value of money. You all hear the saying, right? Dollar today worth more than dollar you are from out now. Why understanding the intuitions of time value centered also understanding why currencies matter and why the time value of money itself shift across time. The fifth big building block for finance is understanding of the basic value. How do you value of cash set of cash flow? What are those cash flows are contractually said? What if the residential cash flows? What the contingent cash flows? Understanding the basic valuation of finally, while financial markets might not be necessary to run a business, near the lubricants that allow business to run well, understanding trading is central to finance. In fact, every trader and likes to make a money without taking any risk. And in fact, you would like to invest no money, no risk, and make a that called the arbitrage understanding. What a what makes arbitrage is so difficult in markets? It's again central to thinking about finances slow. Take a steps in each in the right directions on each of these six concepts. Let's start with the concept of a business. You have seen a finance and accounting balance sheet, right? You have got assist. You got a library's financial balance sheet lays out of the how we think about the business in financial balance sheet. You want to see asset and liabilities just like you do in accounting balance sheet, but unlike an accounting balance sheet in a financial balance sheet, when we think about the assets, we think about what we have already put in these assets, what you are invested in them, we are expected to you to make from the assets in the future. Always about the future. That's going to change your perspective. What you seen on the asset side of the balance sheet, on the library of side of the balance sheet. I like to believe that in the finance we keep it simple. What since they are making a money for a business, one is you can borrow the money, that is debt, other than you can use their money of the equity. As you expand the business, layers of debt to equity mighty changes, but they still remind you, there are still remind you only two ways you can fund a business: debt in equity. Second big idea, finance and cash flows. We make a big deal about cash in finance. It's useful, it's a critical, and understand why cash flows can be different from our earnings, because often are from informations We have a companies to take our accounting earnings understandings. Why cash flows earnings are different, it's important to understanding why some of the business that look good in an accounting basis might not be worth very much other than looking good on accounting basis could be worth a lot the second. Big idea is the flow of that I would like to get through the cash flow and can take one three forms of the can be contractually said that at the time you can entering agreement that what we you can get a corporate bond at the bank loan, they can residual bank cash flows. If you get you when you are the investors are they can be contingent cash flows. What is the contingent cash flows? The cash flow will be happen with something else, happen if an even accused understanding those different cash flow is useful. And valuing those cash flows then comes to the concept of risk. We are as a human being risk of us say that will all the time, but what does that mean? Understanding how we came to the conclusions are that we are risk ours is central starting to the think about risk and to convert the risk aversions into our decision making. We need to do things one we needed to understand the risk is not bad thing is not something avoid to because become great a business you often to seek up a risk, but you have to seek out the right kind of risk is right. Risk is two-sided basis of it's good and good sided to bad side. You want to make sure the trade-off the favor of the second big idea. We are going to promote the think about the risk is an investment. You got to look you would you ask the questions through the why is the think about the publicity trader company you have got thousands of shareholders you got managers each you might have very different perspective on a risk in a decision whose risk should be dominated. Thirdly, we have got converted the risk perspective into a risk number of something we can bring in explicitity into a decision making. You could actually argue that the history of the development risk measures closely parallels the development of finance as a discipline. The fourth big idea is the time value of money. If you have taken a finance class, you unabashedly have a financial calculator. Take a look at the calculator, take a look at those buttons, take a look at the PP sound, and the look how on the out of it. It's amazing how much finance it's a problem fact. Every finance starts with a Nostrum dollar. Today it's worth more than the $1 year from now. But why understanding the institutions become the why dollar today is worth more than the dollar year from now? It's a central finance of converting that institution into mechanics. In other words, if give you a series of the cash flows, can you bring them back today, or can you move them forward to do different point in that skills? Anybody who claims me in finance has to have which bring us to the valuation. Well, have an entire class on valuation, but I'm going to start off saying something believe in valuations choose to make it complex. In fact, I am gonna argue that understand valuation you got to go back and think about those three kinds of cash flows I would talk to. Valuation and actually different depending on the other types of cash flow. For a contract resets cash flow, the way we do valuation we used to promised cash flows, we discount them back to a default risk adjusted this country that how value bond promised cash flow, the coupons in the face value of default risk adjusted cost of depart debt. We used to discover them residual cash flows. We estimate the residual cash flows, those expected cash flows. We discover them as a bucket risk that reflects as a risk we as investors see when we invest the residual cash flows. How we value the equity of the contingent, we need to different token the use of option pricing. Well, talk about the basic options of pricing, but if we can't get the three concepts of down the value of the fine anything. Finally, there's the trading, as I said, financial lubricants allow a business to operate. So, understanding the notions of buying and selling, notions of training, critical understandings of financial. So, let's start with the every trader's dream. Every trader's dream to find something to risk free and make more than risk free resign and put differently risk and walk away to the profits. But pure money machine that's called arbitrage practice is almost impossible to find our budgets. If it exists, it's there are a transition there then is gone. So we are going to talk about the frictions of the marketplace that cost is to despair. and why it's so difficult to about things it's exist in the markets. And we are going to talk about two big frictions. So first, trading is cost nice is things that's easy to say, that's a dollar 4.95 I have to pay when I trade. Trading cost much deeper than include their other items. We don't even understanding those trading costs are central, and understanding why we are free lunches so difficult to trading the other taxes. You have all heard the old saying, the right three, only two things in the life I guarantee: death and taxes. And I'm not even sure about the death taxes are an issues and investing. They have to be an issues because the investors when we invest the companies, we get a spend of tax cash flows are also bringing taxes into a decision making to trading into a investing central. So let's play the foundations of the how taxes enter into the process. Those are foundations which are going to build these corporate finance and valuations building. So it's make sure we get the foundations right. Thank you.